It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
All righty. It is the Jill on Money show, and we are so happy you're joining us today. This is like the best part of the week for us. We love putting together this program. We like talking to you, listening to your questions, interviewing cool people. If you do have a financial issue that has arisen, I know it's July, I know it's the summer, but things happen. You can't just write it off. You can't just say, okay, for the next 10, 12 weeks, I'm just not going to do anything. In fact, it's a great time to do some stuff. Maybe the kids are at camp, taking off for the summer. Give us a holler, 855-411-JILL. Send us an email. Ask Jill at jillonmoney.com. Mark, when are you done with your second unit of the CFP exam? July 20th. So you got 2 down, and then when do you start the next one? Oh, so you're going to take August off. Very good. All right. Mark's studying. He's going to be a certified financial planner before you know it. Although you might do it all except the work part, right? You're going to try for an exemption? He doesn't know, but he's just doing this because he's knucklehead. And I am the senior CFP board ambassador. So anyway, we're cheerleaders for the CFP. If you've got a financial question, give us a holler. Ask Jill at jillonmoney.com, 855-411-JILL. That's our phone number. Diana from Washington State is on the line. Hi, Diana. Welcome to the show. What can I do for you?
Hi, Jill. Thanks for taking my call.
Sure.
I have a question. I have a insurance policy. Now, first, let me tell you, I have no heirs, but I have an insurance policy that I had in place when my mom was alive in case something happened to me that she'd be able to pay off our house, basically. And it's a policy that I pay $40 a month for, and I believe it's in good until I'm 85 if I can continue paying on it. My question is, if I've seen some things online and on the radio that say you can sell policies, and my question is, if I go through and try to sell this policy, how you go about pricing them so that, you know, it's a $300,000 policy.
Is it a whole, what kind of insurance policy is it? Is it a whole life policy?
No, I think it's I think it's term. It's a term life. And they said,
okay.
They said it doesn't matter whether it's term or, you know.
Okay. I really have no idea how you might price that. And I have like zero experience with this. So I know that there are, so this is called a Viatical settlement. That is, but I really don't know how it's done. So what I'm going to have to do is I'm going to have to kind of check this out and get back to you. I'm going to have to see who knows something about Viaticals. I have to go find some super smart person and determine whether it's worth it or whether you just say, forget it. I'll just get rid of this policy and save myself $40 a month. So have you done any research yet?
I have not. I haven't contacted the company, but I wanted to find out, you know, would they just pay the premiums that I've paid up until now?
No, I don't think so. I think they give you some. I think that they give you some. I think they give you like a lump sum up front, and then they take it over. But I don't know how much, and I don't know how much it would be. And I imagine there's a price to do it, of course. But I have to say, there have been a lot of there are a lot of bad stuff that happen around Viatical contracts, settlements rather. So they are based on how, you know, your life expectancy, and then when you actually die. So I don't know if you're going to. How old are you now?
I'm 58.
Yeah, it's a long time. I bet you don't get that much for it. I have no idea. I'm going to tell you what you should do. First of all, go to your Washington State insurance regulator and go onto that website and check check out if there's any information there. You also may want to go to the National Association of Insurance Commissioners. And the Federal Trade Commission would be the one who oversees the sale of life insurance policies. So I would check those out. I'll do a little research on my end. We'll communicate and find out what we both find, and let's see where we stand. I mean, it just may not be all that much money. So thank you so much for calling. I haven't heard the term Viatical in a long time. It's kind of funny. I mean, not that funny, but interesting. How about that? Funny, interesting. All right, let me do another question here. I got a bunch that I always have in my back pocket. Okay. This is one of my favorite questions that I've got, which is really more of a comment. Why is age 65 to 67 the target retirement age? I've worked for 12 years already, and now I have to work another 33. Oh, my God, kill me. Okay, why would you invest in an index fund when valuations are so high right now? That's another question I got. Valuations aren't that high right now, but more to the point, market timing does not work. Every time people will say to me, like, well, I don't want to invest because the market's too high. Then what happens? Things go down. Then what happens? You're too afraid to invest. What do? You know, you cannot play this game. You're asking for trouble when you are trying to outguess when the market is going to move higher or lower. Okay? So there it is. Okay. Let's see. If I'm in a higher tax bracket now than I will be during retirement, does it make sense to use my company's 401k Roth option? Well, it depends how old you are. I like this Roth 401k because, first of all, you might be able to use a Roth 401k if you wouldn't normally get to use a Roth IRA from the income perspective. That's one really good reason to do it. And it's nice to have some money that's already been taxed. I think that I'm a fan of the Roth 401k. Not for everything, but I think it's not a bad thing to have some money. You know what your tax liability is. Remember when Ed Slott was on the show? He loves the Roth because he says it's like the one variable that you can really understand that this is money that has already been taxed, so you don't have to worry about how that might affect you. Maybe you want to work in retirement. It's not subject to the minimum required distribution. Roth is a kind of neat thing. Really is. All right, you're listening. Pardon me? Named after Senator Roth of Delaware. Mark just tried to get me on that. I knew it. It's Jill on Money, 855-411-JILL. Send us an email. Ask Jill at jillonmoney.com. We'll be right back.
Annuities, IRAs, 401ks. She covers it all. Back to Jill on Money with Jill Schlesinger.
Let me out, don't tell me.
You're back with Jill on Money. This is the program that takes the mystery out of your financial life. I'm Jill Schlesinger. And hey, by the way, we got all sorts of new stuff that's floating around, and it has nothing to do with me. Oh, I had to text Mark the other day and say, what's my Instagram password, which he did not know. So that was not helpful at all. However, Mark, we'll have to figure that out. I have an Instagram account now, evidently. I wanted to put something on there. I didn't know how to do it, but I just wanted to put something on there. Anyway, it's under... You see, there's two accounts. That's the problem. One is under my name, and the other is Jill on Money. And I have 0 posts there. Someone must have set that up. Joe must have set that up for me. Oh, now I'm going to get in trouble because someone left a review of the show that said I talk too much to you. Darn it. Okay. Now I forgot who's on the phone. Is this Steve from North Carolina? Steve, welcome to Jill on Money. What can I do for you, sir?
I am sort of trying to figure out what the pros and cons of an annuity are.
Okay.
Near as I can figure, the pros are a steady funding stream, and the con is the person who sold you the annuity.
That is, I never thought of it that way, but it is well put. I mean, the problem with an annuity is not that it is a flawed product. You have hit the nail on the head. The problem with annuities is that they tend to be oversold. So you're absolutely right. The premise of an annuity is that an insurance company has created a product where it takes money from you and is able to then generate a stream of income, a constant stream of income. Now, there are many ways that can happen. You can give the money to the insurance company and say, turn the stream on right now. That's an immediate annuity. Then there is something called a deferred annuity. Here's a bunch of money, and I'm going to send it off to you. And then in the future, I'll want to turn that stream of income on. Now, that is a premise that's quite appealing to people, right? Because we know pension plans have disappeared from private companies in big, huge numbers, and that the idea of having a stream of income is indeed something that I think makes you feel good, right? I don't have to live just off this big chunk of money. The problem occurs with an annuity in that there's lots of bells and whistles associated with it, and each of those bells and whistles costs money. And so the pricing of an annuity contract is so steep that the idea of a constant flow of income comes at such a high price that people are basically paying up for something they probably could create themselves. Now, there's also a brand new category, not brand new, but newish, I should say, of annuities that are low-cost annuities. And, some of the big companies are getting into that. And so probably worth exploring. But again, so much of what we know from the industry is that the cost of these contracts is so steep that they can really be a loser for the investor.
So what would be the difference of having a funding stream from an annuity versus, say, having a bunch of mutual funds or stocks or something and having a broker that would supply you money every month based on your principal just by selling things and delivering it to you?
Couple of different things. Number one is that if you're talking about a taxable account, meaning just a plain old individual or joint account, the annuity structure is protected from taxation while it's in the accumulation phase. So that's one advantage when you look at one versus the other. When you pull money out of the annuity, a portion of the money that comes out is your cost basis, what you put in, not taxable. The other part, the accumulation, is taxed at your ordinary tax bracket. So I just want you to keep that in the back of your head, stick a pin in that concept that you got ordinary income out of the annuity. Now, in your case, you say, hey, what's the difference? I have a broker, or even you yourself, you're managing your money. And, what you do is you're smart about it. You don't just sell things willy-nilly. You say, okay, for the next year, I'm going to need $50,000 out of this account. I'm going to set aside $50,000 in cash, and that's going to come out, every month. I'll take 1/12 of $50,000 every single month. It'll come out. And I will make sure that the portfolio is created so that the cash portion gets replenished throughout the year. Maybe I'll have dividends flow into there. Maybe I'll have some interest flow into there. And at the end of the year, if I'm coming up short, I don't have enough money for the following year, I'll sell securities to make up the difference. That is a perfectly reasonable way to approach creating income out of an account. The downside is that you can really do a number on yourself if you try to time the market. So you have to be very disciplined to be able to carry that off. The advantage is, A, you are saving that cost, and B, the stuff you sell is subject to usually long-term capital gains, not ordinary income. So in many respects, the ability to manage your own taxable account that actually is more tax efficient than the annuity structure. So again, I give the avoid the annuity structure an advantage for tax efficiency, but again, a lot of people get freaked out. They don't want to necessarily trust a broker to do it, or an advisor, or themselves. They just want to know, no matter what, this is the stream of income I get.
Well, that gives me a couple of things to think about. And the last thing that I think about is, why don't I just sell everything, put it in a passbook savings account so I can get it when I want it, even if it's only paying 0.1% now. Maybe it'll go up tomorrow, just like maybe tomorrow the market will go down.
Okay, here's a good question for you. Tell me how much money's in that account, and let's see if you can really do that, because there is a group of people. There are a group of people who can do that. How much money's in that account?
Oh, if I wanted to do it with, give me half a second here.
Okay.
Or say 500,000.
Okay, and is this all the money you have in the world?
No.
Okay, and how old are you?
70.
Married? Single?
Married.
Okay. How much money do you need on an annual basis out of that $500,000?
Oh, right now, none.
Okay, so I'm going to give you. This is so interesting. I have always thought in my mind that there is. I mean, there's a cost to that, because if you threw it in a passbook savings account, or even let's just go one step further, if you put it into a CD ladder, you bought a bunch of CDs, you just said, I want it to be safe no matter what, and you said, I am willing to forego the upside to protect my downside. What you do lose is you lose against inflation, because right now you're not going to get interest that will keep pace with inflation, and it's not exactly tax efficient. But if you have so much money that you actually don't need it and you hate risk, there's a case to be made that no matter what, you're actually in better shape. So I always thought that it was like a luxury of the rich to invest in an inefficient way. So if you're listening out there and you say, I don't need my money at all, I hate risk, I don't want to lose, I don't want to buy a product, I just want to be safe, build yourself a little CD ladder, know that you're losing against inflation and maybe taxes, and if that gives you more comfort than taking on any other potential strategy, which would keep your money ahead of inflation or leave more to your heirs, then you know what? I'm not going to say that's a bad idea. That is, you have earned the right to make a decision that's not the most financially prudent, but emotionally, it is the safest. So, Steve from North Carolina, thank you so much for giving us a holler. Great to talk to you. And if you are listening and you've got an annuity question, we'd love to talk to you as well. 855-411-JILL, that is our phone number. Our email address, askjill@jillonmoney.com. Don't forget, listen to our podcast. It's called Better Off. You can get it anywhere you find your podcasts, Apple Podcasts, Stitcher, Google Play, SoundCloud, whatever. But check it out. And check out our YouTube channel. Just search Jill Schlesinger. You can see some good stuff and old shows, all that fun stuff. All right, Jill on Money. When we return, more of your questions. We'll be right back.
Young, old, it doesn't matter. She's here to help you. Back to Jill on Money with Jill Schlesinger.
You're back with Jill on Money. If you've got a financial question, we want to hear from you. 855-411-JILL. Send us an email. Ask Jill at jillonmoney.com. Hey, I'm very excited about this. There's some big news coming out of the CFP board. And, I'm the senior CFP board ambassador. And it really does talk about the rule. What's being contemplated is to make sure that anyone who is a CFP knows that when they act, when they're basically doing anything in the financial world, they are held to the fiduciary standard. So it doesn't matter whether you work for a company that doesn't adhere to that. If you hold that mark, the CFP mark, then your certificate, you would be held to that. So we're going to talk more about that in the future because got some folks from the CFP board who are going to come on because I want to do both, Mark. I want to do both for here and also for the podcast. Slightly different. Okay. Because we have a lot of folks who listen to this program who are in the business of giving financial advice. So I want to shout out to all of my CFP buddies. Okay. Here is an email from Gordon who was commenting on an article that I wrote, my syndicated column for Tribune. And he says, a friend of mine got married a few years ago. It was the second marriage for both of them in their mid-60s. They decided to get a prenup. Each contacted his or her own lawyer. Both lawyers were new to the couple. Each lawyer drafted a prenup to the client's satisfaction. But when each lawyer reviewed the other one's draft, both lawyers said the same thing. The other lawyer didn't know the law and they could not reach a compromise. Both parties urged their own lawyer several times to work with the other lawyer so that an agreement could be worked out. But after several redrafts, the lawyers just couldn't agree. The process lasted 6 months, delayed the marriage date. Legal costs $3,000 per lawyer. Couple gave up, wrote their own prenup. What advice would you give to a couple having this problem? Get new lawyers. That is an insane story. And I'll tell you what, shame on those lawyers. Shame on those lawyers. Because to me, that is really an absolute abrogation of your duty. Your client is saying, make a deal. And you're going out and trying to prove how smart you are, whatever you're doing. It's nonsense. And I think that it is important if you have a relationship like that. As soon as they said that if they did one round and they couldn't get a deal, I'd fire both of them. And I probably wouldn't pay the bill either. That's not nice. Maybe I'd pay the bill. Should I pay the bill or not, Mark? Mark says we have to pay the bill. All right, we'll pay the bill. But honestly, it's terrible. Just terrible. Okay, let's do another one. Here we go. This is an email, follow-up email. Hold on, let me find the original for a second here. This is, I'm old enough to withdraw from my 401k without penalty. And this person wants to do renovations to a 40-year-old home, and I asked for more follow-up. And so here is the follow-up, which is, let me begin by thanking you for helping people like me. I'm 61 years old. It took me 5 minutes to figure out how to play your audio clip on my old desktop computer. I don't want to add to my tax liability. I'm just looking for a small amount, maybe $20,000 to renovate my kitchen. My home's 40 years old. It's starting to need renovations, blah, blah, blah. So currently earn $53,000 a year. Going to claim Social Security benefits when a little bit later, so at 66 and some change. There's a current loan against my 401k that must be satisfied in February of 2018. And I'm going to continue contributing to my 401k when the loan is satisfied. I'm debt-free. I have $3,000 balance on a major credit card, which paid for my father's needs when he passed away. My credit rating is high. And the question is really, what's a good rate? Should I wait till February to take another loan against my 401k? Okay. So now, because you only need $20,000, getting a loan against your home may not actually be the easiest way to do this. Potentially, what I might think about doing is waiting till you are paid off, right? So you're going to work for 5 or 6 more years. Let's say you're going to work for 5 years. You wait until the beginning of next year to take a loan. When you take that loan out, you should think about paying off the credit card, number one, easy peasy, and taking out enough money against that account to pay for the renovations. The other choice that you would, and that would, you pay yourself interest, but there's a downside to that. The other choice is you get a home equity line of credit, not a home equity loan, a line of credit. And you establish that against your house, and you'll have your equity in your home against that. And you withdraw the money as needed. So the benefit of that is that, let's say the interest rate on something like that is usually the prime rate plus some amount, but it's going to be 3 or 4%. The one issue I have around getting the loan against your home in that respect is that you still have to pay it off, and you have to be disciplined about paying it off. So if you can be disciplined about that, then maybe that's the best idea for you. And in terms of getting a new car, then I would probably look to try to get an auto loan with a very low interest rate, because I think that might really be helpful to you. I hesitate to tell you to take the money for the car, the money for the renovation, the money for the credit card, that $50,000 or so. I hesitate to tell you to take that from the house, even though it might be financially prudent to do so, because I'm nervous you're not going to pay it back. So if you can pinky swear with me that you will pay back that loan against your home, then you can feel free to do it. Or you can wait till next year and get a loan from your 401k and get a car loan. But that will force you to pay those loans back. That's the benefit of it. Okay, you're listening to Jill on Money. If you've got a financial question, 855-411-JILL. Send us an email, askjill@jillonmoney.com. We'll be right back.
Back to Jill on Money with Jill Schlesinger. Want to get in touch? Call or email any day, anytime. 855-411-JILL or ask Jill@jillonmoney.com.
You're back with Jill on Money. This is the program that takes the mystery out of your financial life. I am Jill Schlesinger, CBS News business analyst. You know how I got that title, Mark? Connie and I made it up. Sat in her office one day, went through a whole bunch of titles, made that up. That's a friend of ours from CBS Radio who is recuperating right now. We're sending her our very best wishes. If you've got a financial question, 855-411-JILL. Send us an email, askjill@jillonmoney.com. Hey, you know that Mark has been big time busy, created a YouTube channel, an Instagram account. Are there any other thingy accounts that I need to know about that you've done? Any other social? We're on Twitter at Jill on Money, Facebook, LinkedIn. I got to post some more on LinkedIn. I've fallen off there. Oof. It's too much stuff going on, man. I know I'm going to lose my influencer status. I think it's going to get watered down anyway. It already has. Used to mean something. Not sure it does anymore. I don't know. I'll have to see about that. Anyway, check out our podcast. It's called Better Off. You can get it at the Apple Podcasts, Stitcher, Google Play, SoundCloud, anywhere else you find your favorite podcasts. Mark, what's your favorite podcast these days? What are you listening to? What's getting you going? Well, what news stuff? Come on, we got to give a little curation here. Yeah, really? So Mark listens to the BBC World News. I like... Okay, I think that there's a great snippet in the morning. The one that I like is the NPR Up First. I think that's pretty good. Is that the one? Or did I make that? I may have just now screwed that up. Is that the? There's one that's NPR, and there's one that. Up First, the Daily. That's the other one. Is the one from the New York Times. Mark's not a fan. How about the CBS This Morning podcast? I've been on that a few times. You know what else I like? The podcast. If you guys are into like policy stuff, I'll tell you what's so cool. The Weeds. That's Vox. I think that's good. All right, give me one that's not a money one or just like a fun one. Give a fun one, Mark. Come on. Yeah. Here comes this fun one. Emperors of Rome. What is it? Oh, my God. Each week it's Roman history and they profile somebody. That's so cool. You know what I like? It's not really money, but it is kind of, I love Hidden Brain, which is an NPR podcast. And I love Radio Lab, which is so freaking cool. I love it. Love it. All right. That's it. You want a really fun one? You want to feel hip? Go listen to Call Your Girlfriend. I feel so old when I listen to it. So good. All right. No, I am not even saying that on the air. Mark just gave me something, a dirty one. Anyway, check out that. Get into the podcast universe. It's fun. Okay. Jeannie writes, everyone says, keep your money in TSP, Thrift Savings Plan. Plan costs are so low, you don't have to worry about financial schemes. But, Jeannie says, I am considering moving my money. I've got $750,000, of which $150,000 is a Roth TSP. Thrift Savings Plan requires us to take money out at a proportional rate, so I cannot allow my Roth money to continue to grow once I need to start withdrawing the pre-tax money, which will be in about 5 years. I wonder what you think about rolling the whole amount into a Vanguard or similar account, at which point it will be separated into pre-tax and Roth accounts. I would then start a Roth conversion of about $20,000 each year for the next 5 years. Since I have very limited income right now and I'm living off a brokerage account, that's okay. I get it. So you get it. She's going to, roll it over, start converting. Then she would allow that Roth money to be the last money she ever touches. Even better, pass it on to my daughter. I would be careful to convert only what I can do without throwing myself into a higher tax bracket. I just have a gut feeling that it might be the wrong move, even though on paper it looks like the way to go. It's so hard to take that step and roll over that much money, so I'd like your opinion. Thanks. You know what? Why not? Why is this a hard move? I mean, if you're going to go into, yes, the Thrift Savings Plan is cheap. So let me start by saying that. Yes, it is cheap. However, the Vanguard funds are also going to be cheap. So that's kind of the same. It's really the sort of a similar comparison. I like the idea of being able to convert the money. I like that you're doing it in a methodical way. It's just scary because it is a big amount of money. But I don't know. I think that sounds like a good deal. So might as well start. Do it. Make it happen. Dang it. Thanks for writing. I'm ready to go with that. $750,000. If you can convert your Roth, don't forget, you got to presume that she's got the money outside of her retirement account, right? That's a big if. You must have that money outside of your retirement account. Otherwise, you are going to be in big, bad trouble. Okay? You're listening to Jill on Money. If you've got a financial question, 855-411-JILL. Send us an email. Ask Jill at jillonmoney.com. We'll be right back. You're back with Jill on Money. If you've got a financial question, 855-411-JILL. Send an email. Ask Jill at jillonmoney.com. I'm going to consolidate a bunch of questions that I've recently gotten about minimum required distributions. So here's the problem. Once you turn 70 and a half, the government wants to get paid, meaning that the money that goes into a 401k, a 403b, a traditional IRA, that money hasn't been taxed yet. So government put in this weirdo rule, which is, in the year after you turn 70 and a half, you have to start pulling money out, blah, 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 blah. So it used to be a lot harder because it used to be that the onus fell on you, but now IRA sponsors are required to compute the amount. So one of the things that I think is really helpful is you can go check out tables, but there are calculators online. It is important for you to do this because if you don't, the penalty is 50% of the amount that you have not withdrawn. Okay? So that's very important. That's enough to make me say, I'm not missing anything. And what's really important here is that you get a plan together. Some people wanted to ask about whether or not you should be timing this or not. Should you do it beginning of the year or the end of the year? So I think what's helpful is to start by just doing it pegged to when you need any cash flow. But if not, then, probably the end of the year is better, not the bitter end. Okay? And remember that every single person who has an IRA account, it's your IRA. It's your Social Security number. So you cannot take, if you're married, it's not as if one spouse can take a distribution from another spouse's IRA. Okay? All right. That was a quickie. Jill on Money, 855-411-JILL. Send an email, ask Jill at jillonmoney.com. We'll be right back.
I need a dollar, 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 that's what I need. Hey, hey, well, I need a dollar, 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 that's what I need. Well, I don't know if I'm walking on solid ground, 'cause everything around me is falling down.
It's the weekend, which means it's time for Jill on Money, the show that makes money fun and just happens to answer all your financial questions. Here's your host, Jill Schlesinger.
Welcome back. It's Jill on Money. It's hour number 2, and we've got a very interesting guest for this hour. Her name is Sandy Jolly, and the title is amazing. She is a reverse mortgage suitability and abuse expert. And I'm really interested in this because we get so many questions about reverse mortgages. So why not have an expert and someone who's advocating on behalf of consumers? So Sandy Jolly, thank you so much for joining us.
Thank you, Jill, for having me today.
And we have to thank our mutual friend Janet for connecting us. We love our Janet. So Sandy, tell me, how does one become a reverse mortgage suitability and abuse expert?
It was an accident. My parents were taken advantage of by a reverse mortgage lender at a time when my dad was in the last month of his life on narcotic pain medication, and my mother had Alzheimer's disease and couldn't complete a sentence.
Oh,
so
my God.
when my dad died, we found these reverse mortgage papers. Go ahead.
I'm sorry. And so what was your experience before then? What were you working and doing something else? What were you doing in that moment?
Yes, I've been in the nonprofit world for many, many years. And at that time, I was working as executive director of a nonprofit called Women of Los Angeles and Women of D.C.
Mm-hmm. And so you discover this reverse mortgage. What did you think it was?
You know, the only thing I knew about it was that I saw the commercials on TV with James Garner and Robert Wagner talking about how great they were. That's all I knew. And from that, my parents called just to get information about it. I didn't even know that.
Mm-hmm.
And a salesman came out to their home and took their loan application then and there in a very aggressive way.
And then, so how did this get cleaned up in your personal story? Like, what happened in the case of your parents? So your parents, let's back up a second. So a reverse mortgage is a product that is sold to people who are over the age of 62, and the promise is hey, you've got all this equity in your house, right? And you want to get liquid. We'll show you how, right? Is that the basic premise?
Right. That's the basic premise with one other thing. You know, it's a way for you to stay in your home for life without making a house payment.
And so what happened in your parents' case?
In my parents' case, they didn't need a reverse mortgage. They had assets. They had a mortgage payment of $500 a month that they could afford, and it was just totally unneeded. So I don't know exactly what the salesman said to them, but he talked them into signing it. I think he pressured them into signing. And in their case, as soon as we found out, my sister and I found the documents when my dad died a month after signing them, and I tried to give them money back. They got $80,000 for their house worth $530,000.
What?
Mm-hmm. That had $400,000 equity in it.
How is that possible?
It's a one-time upfront payment, and it's based on an algorithm they use: the age of the youngest borrower, the value of the property, and the current interest rate. So, it's outrageous that was the amount of equity they got. That did us absolutely no good. It sat in the bank for months.
Oh, my gosh.
So I tried to give it back 3 times, and at that time I was very angry, and I didn't want to pay the $25,000 it cost them to get this loan.
Right.
So they refused every single time, and then I entered litigation with them, and Financial Freedom hired $1 million attorneys and blamed my sister and my whole family for being greedy, evil children.
What?
It
no
sounds
way!
Like a horror story.
It does. It's horrible.
And the jury bought it, and said, in spite of my parents' health being testified to by their treating doctors, they hired an expert doctor who said my parents were sharp as tacks, who never even met them, and the jury bought it, and we lost.
But then, wait a minute. But you got busy after that, right?
I did, and honestly, as soon as I found the reverse mortgage documents, I'm the kind of person who wants to know exactly what happened. What was this? And I began researching, and I reached out to every single advocate and expert in the country, lawyers included, who knew anything about reverse mortgages, and I educated myself. And that's how I became, found my purpose in life, really.
And if I may, you also have a website, right?
Yes, I do, and I created that when I was very angry too.
I know. I want you to say it because it's a kind of the best website I could imagine for given your circumstances. So why don't you tell everybody the website?
It's elderfinancialterrorism.com.
There you go. Okay. By the way, so we're joined by Sandy Jolly. She's a reverse mortgage suitability and abuse expert. You've done a lot of testifying before various regulators and speaking out against mergers of companies that have been selling these reverse mortgages. How did you get into that part of it?
That was sort of accidental, too. Some of the advocate groups that I met, I became very close with, and we sort of formed a informal partnership, if you will. And one of them is California Reinvestment Coalition, and they have also filed Freedom of Information Acts to get information on other mortgages, but on reverse mortgages. So I became the de facto expert on the reverse mortgage part.
Well, that's good because you are our expert on the reverse mortgage part. And when we come back with Sandy Jolly, we are going to pick apart the reverse mortgage beyond the basics. And what we want to go through is this fabulous thing that you have on your website. And we'll put a link to your website from our show notes. It's elderfinancialterrorism.com because there's if you're considering a reverse mortgage, You really need to know about this. You need to understand what some of the downsides are. And I'm wondering from Sandy's perspective whether there are any upsides. Maybe there are some people who need a reverse mortgage. They can be better. Have they gotten better? These are some of the questions that we are going to follow up with in our next segment with Sandy Jolly. It's such a nice name. It's such a jolly name, and yet she says elder financial terrorism. It seems like a little bit of a paradox, but I'm going to get through that during the break. You're listening to Jill on Money, 855-411-JILL. Send an email, ask Jill at jillonmoney.com. We'll be right back.
It doesn't matter if you're 25 or 65. Jill Schlesinger is here to help you. Back to Jill on Money.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Our phone number here is 855-411-JILL. Our email address is askjill@jillonmoney.com. We are joined by a special guest this hour. Her name is Sandy Jolly. She is a reverse mortgage suitability and abuse expert. It's amazing because I'm looking at your bio. It's just pretty tremendous to take a personal experience where basically it sounds like your parents were scammed by somebody, lose the case, but then go on to do so much good for everyone else. So thanks to you, Sandy, I'm learning a lot. This is excellent.
Thank you so much.
Okay, so Sandy, is a reverse mortgage in essence a flawed product or sold to in other words, like there are times where I say there's like there are very expensive insurance policies, and there's like some fraction of the population that they should be sold to, but they're just oversold. So is a reverse mortgage a good idea but a bad execution?
It can be a good idea, and that's the key word, can. But the missing link in the origination of reverse mortgages is two things. One is suitability, and for the consumer, is this product right for you in the long term? Is this going to be beneficial to you in the long term or harmful? Mm-hmm. And that is missing completely from the process. The HUD counselor or the salesperson cannot give you financial or legal advice, and that's what you need.
And people don't know that. They don't, in other
Right.
words, they think that somebody coming to say, selling me a financial product has to put my best interest first, right?
Right, and that does not exist in this product.
Who?
And consequently, it makes it a risky, very risky product, both for the consumer, the lender, and the FHA insurance fund. They're all at risk.
Do you think that, I know there were changes that took place where this really was a program that now that it is the HECM, right? And
Yes.
it's through HUD, and that people think that these are legitimate because of the HUD involvement. Is there some confusion there among consumers?
Absolutely. It is a federally insured program, and all the lenders advertise that it's federally insured, so it's safe. Well, au contraire. This product is HUD, first of all. It's a big bureaucracy. It has no structure or system in place to audit, regulate, or enforce any of these consumer protections. And there are very few of them that exist in this product. And that's where the problem comes in.
Yeah. It's funny. You'd think that there was like a great move, and then all of a sudden it actually just adds to the confusion. Can we go through it and like break down how these work? So, let's talk about this. The purpose. When did these things start? First of all,
I think they started in the late 90s initially. It's changed a lot since then.
And what was it created to do?
I believe it was created to help seniors stay in their homes, for life, and give them a little extra income in most cases, or reduce their output of money by taking away the house payment.
And what do you think is the biggest misunderstood aspect of these mortgages?
I think the biggest misunderstood aspect is that all these commercials and even the lenders, they talk about features of the reverse mortgage, like it lets you stay in your home without making a house payment and all these kinds of things. But they don't talk about what's necessary to get one. Is it going to benefit you? For instance, this is a perfect example. When the borrower either dies or becomes unable to handle their financial affairs on their own, and the heirs need to step in and deal with it, they need to have legal authority to talk to the servicer. And that means they should be told that they need a trust from the beginning, so that there's a trustee who can always talk to the servicer.
Can you do that with just a plain old power of attorney? In other words, if your mom is getting a reverse mortgage and you want to go talk, can you say, hey, I have power of attorney, here's durable power of attorney. Can I do that then, or must it be a trust?
Yes, it can be a durable power of attorney while the consumer is living, while the borrower is living. Mm-hmm. But the minute that they lack capacity or that they have passed away, that power of attorney, of course, is invalid. So you have to have that legal authority in some way. And in states like California, where probate can cost 10% of the value of the property, and the property is the only asset, you don't want to have to go through probate to get legal authority.
So okay, wait a second. The other part of this is there now an underwriting standard for this? Don't you have to go through a little bit of hoop jumping for these, or not? Because I thought there were some extra things as of 2015 that had to happen, or not?
Yes, there's called a financial assessment tool that they have to go through. So it's a little bit of a qualification. And for the most part, most lenders are pretty good at following the financial assessment. Certainly, if a potential borrower does not pass the financial assessment, they absolutely should not try and find a way to get a reverse mortgage or go to somebody less reputable who's going to avoid the financial assessment, which some unethical lenders will do.
When you go through this, we have like the problem about when you die, this has to get paid back. That's often sold to someone when it's not suitable. What about the cost of reverse mortgages? Has the cost come down at all? Because I remember years back it seemed to be a very expensive way. It's more than what, say, a lot of people will say, oh my gosh, this is, the interest is the way higher. I mean, you're going to pay more interest than you would for a 30-year, conventional mortgage. But what does it cost to get one of these mortgages?
It still costs a lot of money. There's two things that cost a lot of money. One is you're paying for the mortgage insurance premium a fee up front, which can be $12,000, say. And then you pay monthly payments on the mortgage insurance premium. The cost of the loan, say in my parents' case, it was $25,000. Okay. So that's what you're paying compounded interest on from day one. That plus their $80,000. They paid compounded interest on that from day one, compounded daily or monthly, and it begins to really add up.
Which essentially means that depending on how long the borrower lives, the loan amount can actually end up being greater than the house is worth, right?
Correct.
That's the part that I think people don't get.
Right.
Right? Because they say, oh, well, and also you don't have to pay the loan back while you're living in the home, but when you die or you sell or you move out of the house, that's when it has to be, that's the trigger, right?
Right. Those are the triggers. There are actually 17 triggers. I think they're listed on my website.
Unbelievable.
And those triggers, if you fail to pay your taxes and insurance, And, the lenders like to say that's the consumer's fault, they should have known. But if there had been a pre-planning, is this right for me over the long term, they would have seen if they could afford to pay their taxes and insurance over the long term. But when they're given a lump sum in the beginning with no financial plan whatsoever, then that's when this situation can arise.
And they're not certified financial planners who are doing this. They're mortgage brokers, generally speaking. We're on the line with Sandy Jolly. She is a reverse mortgage suitability and abuse expert. When we come back, we're going to find out from Sandy who should consider a reverse mortgage and when. Does it make sense? You're listening to Jill on Money, 855-411-JILL. Send us an email. Ask Jill at jillonmoney.com. We'll be right back.
It doesn't matter if you're 25 or 65. Jill Schlesinger is here to help you. Back to Jill on Money.
You're back with Jill on Money, and if you've got a financial question, we'd love to hear from you. Our phone number here is 855-411-JILL. Send us an email. Ask Jill at jillonmoney.com. We are here with a guest, Sandy Jolly. She is a reverse mortgage suitability and abuse expert. She basically went into this by accident because a terrible situation occurred for her parents who were sold a reverse mortgage, and it was, I don't know, it sounds like borderline fraudulent, but anyway, became an expert and testifies before federal regulators like the OCC and the Federal Reserve and HUD and CFPB. And Sandy, we've talked a lot about some of the downsides. Who should consider a reverse mortgage? When is it right?
It's right when the consumer understands, the potential borrower understands that they need to see if it's right for them in the long term. This is not a product for a short-term use, period. So they need to do a little financial planning. And like I mentioned before, the HUD counselor and the salesperson cannot give financial legal advice. So it's really important to include your family or trusted advisors in this process to make sure it works for you over the long term. And I've recommended reverse mortgages to a number of people where we've worked out together that, yes, this is in their best interest in the long term. But it will provide some financial security for them.
It really is. It's education and it's understanding everything that's happening in various scenarios, right? Because, I mean, if you're single or widowed, this is one scenario. But if you're married, there's another scenario. If, you want your kids to inherit your home, there's a third scenario. Like, there's a lot of different things to contemplate. And as you say, this is a much more complicated product than the Fonz is giving you when in that, 30 or 60-second TV spot, right?
Right, absolutely. And that new commercial with Tom Selleck, is pretty powerful. But the borrower, the potential borrower, needs to look at how does these things that he's talking about, these features, do they work for me?
What happens for most people when let's say the spouse passes on at that house? Do we have any statistics about how many or what percentage kind of go okay versus these really nasty circumstances that arise?
I don't have any statistics on that. And at the same time, just consider this. So one spouse passes away, and that particular spouse managed the finances for their entire married life. Mm-hmm. So now the remaining spouse has no idea how to deal with anything, no idea how to pay taxes, or no idea how to manage the finances. He or she's going to be in a world of trouble if they don't get help. And a lot of seniors, and I put myself in that category too, we've been making our own financial decisions all our life, and we're reluctant to include others, or if we get in trouble, to talk about it with other family members. And that's a key here. You must talk about it with trusted advisors or family members and not let it get to the point where it's going to be a problem and you could risk losing your home.
If someone's listening to this right now and has a reverse mortgage, what should they do to, like, maybe a few different things that you should know about your reverse mortgage? So you did it already, so we can't undo it. What should we do?
You should make sure that first of all, your estate wishes are going to be carried out. And while you're living, that you have someone who can step in if something should happen to you, an accident or you lose capacity, that can act on your behalf and has the legal right to do so. So I say a trust, but it can be power of attorney while they're still living. Mm-hmm. But that's one of the keys in getting a reverse mortgage, your wishes for your estate. A lot of lenders have said it's about, the heirs shouldn't inherit anything. This is a loan for seniors. Well, that's not the case. It's the senior has to say what their wishes are for their estate, and those have to be able to be carried out. And that's being prohibited a lot of times because they didn't prepare. They didn't know how to prepare.
If you see that your parents are maybe even thinking about it, let's say you're lucky enough that they talk to you. A lot of people here, who are dealing with their aging parents. What should we do as kids to maybe, because I think sometimes the parents don't want to hear it from us, but is it best to involve like a third party in this at that point?
Yes, absolutely. Somebody else should be involved. This is a complex financial instrument that they're signing, binding legal documents. And as a regular consumer, most of us will not understand the terms. And that's what's missing, too. That's what's missing in suitability. The terms of this, we need to understand what those are.
Sandy Jolly, I cannot thank you enough for joining us. This has been so interesting. And we're going to link to Sandy's website, which is elderfinancialterrorism.com. And you're going to read all about this. It's really interesting. She's got a beautiful sort of beginning to end understanding reverse mortgages. And I love the first thing she says is the site is dedicated to the consumer. The purpose is to educate, explain your rights, protections in every step of a reverse mortgage, from origination, servicing, default, repayment plans, maturity, and foreclosure. Sandy Jolly, reverse mortgage suitability and abuse expert. Thank you so much for joining us.
Thank you so much for having me today, Jill.
Take care. And if you've got questions about reverse mortgages, send them to us, and we will absolutely send them on to Sandy because she obviously is the expert. This is kind of thorny here. These products that are oversold, again, it's not the bad product. It's just selling it to the wrong people. That's what the problem. All right, it's Jill on Money, 855-411-JILL. And send us an email. Ask Jill at jillonmoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back with Jill on Money. Hey, thanks again to Sandy Jolly for joining us. If you've got a question about perhaps a reverse mortgage, just shoot us a note, because I think it would be really helpful so that we could, forward it to Sandy. We could make this work for you. Just remember, there are very few consumer protection regulations that are available around the reverse mortgage market. So the problem is that the servicer and HUD, there are a lot more regulations, but there isn't a lot of regulatory oversight or auditing or enforcement. So I just want to remind you of that. So if you've got a reverse mortgage, if you're considering one, just let us know, and we'll put you in touch with Sandy. That might be helpful for you. All right. Okay. So ask Jill at JillOnMoney.com, 855-411-JILL. I wrote an article, a Tribune article, about helping out with adult children. And I think that this is something that we've talked about in the past, that we're very concerned when people are helping their kids so much that it's hurting their own retirement savings. So, Mark, let's put a link to that in the show notes. I wonder if I actually, did I post it on the website or did I forget to? Maybe I forgot to. I'll put it on the website and then we'll do it. Anyway, according to the Census Bureau, about a third, 24 million 18 to 34-year-olds live in their parents' home. And 1 in 4 of them don't do anything. No school, no work. Anyway, and then we had a separate study that came out which said half of Americans over 50 said they're willing to overextend themselves financially to give their children a more comfortable life. So that, I don't know, we just have to try to strike a bit of a balance here. So I got a couple of emails about that article. One from Ron, who was in Wisconsin, who said that one issue is that the statistic that often refers to the 18 to 34-year-old age group, he said that's usually a point of reference for the demographic, but he does point out that it's not the whole story, that maybe we should be drilling down and do something like 18 to 24 and then 24 to 34, something like that. It may be that we're skewing the numbers, so I think that there's a certain that makes some sense to me. So I don't know if we can get those numbers in a different way, but I'm going to think about that next time I write, because I think that would be very helpful to have that. And then Eva wrote in that there's a corollary to this issue, which is, should your nest egg be put at risk to help impoverished elderly parents? If not, what are the possible solutions? How does one achieve them? My mother is 93. She's in an assisted living facility. She is soon going to need skilled care. She's got 1 year of money left based on her current cash flow. We've looked at Medicaid and at subsidized religious institutions without much satisfaction what to do. This is also hard. This is the quintessential sandwich generation problem where, you may be helping your kids and your parents, or one or the other. But I think that the problem that I see with this is, you want to help out. I'm not sure, I would hate for you to put your own retirement security at risk. On the other hand, we want you to help out your parents. So I think maybe some combination, if you can get together with your family and figure out what you can do, maybe what you do is you have her exhaust her resources, go on Medicaid, and then from there see if you can augment that with some help. But I mean, you can only do what you can do. I think that that's one of the big issues that people are confronting. You can't make this into something that you can't magically find this money out of nowhere. So in my mind, you're going to have to sit down and get real with yourself, with your siblings, and think about what is best for the entire family. You can't have everybody going broke for one. And, in some ways, with an elderly parent, at least you have the option of a social safety net, Medicaid. It may not be the most appealing option, but it's an option. And I guess otherwise, then you have to start thinking about, well, what are the alternatives? Do we have mom move in with one of us and then have somebody, come into the house? I don't know. What I do know is that having a elderly parent who is in need of care can drain resources just as much as an adult child. And there really does you have to be able to strike a healthy balance. I don't know what that is for you guys, but you're going to have to figure it out. Okay, you're listening to Jill on Money, 855-411-JILL. Send us an email, askjill@jillonmoney.com. We'll be right back. You're back with Jill on Money. If you've got a financial question, money question, give us a holler, 855-411-JILL. Send us an email, askjill@jillonmoney.com. The great thing about doing this show is that I always learn something new. And we got this email from a guy, I don't even want to say his name, who writes, if a bank official was digging around in my background and credit history, and he discovered that I am secretly married by virtue of a California confidential marriage license, is he obligated to keep the secret? All right, now this got me thinking, what on earth is a confidential marriage license? So I go, digging around a little bit, because marriage and divorce records are usually public records, right? It's pretty easy. And even with California, you can go to the Office of Vital Records, which is a division of the California Department of Public Health, and find that out. However, there are some couples who want to keep their marriage or their divorce a secret, and I guess in California, especially all of those big celebs. Anyway, I think that California is the only state that allows couples to obtain what is called a confidential marriage license. That's just totally fascinating to me. So the question of whether if somebody were to find out that by accident that you are able to essentially get married in secret, does that person now have to hold that information? I would presume so, because I think that the banks are held to any privacy laws that exist. So I'm going to go with, I'm guessing yes, that if that's the case and someone finds out that you were married confidentially, then you're able to keep that secret, or they would keep that secret. Okay? We learned something new today. Thanks again for listening. 855-411-JILL is our phone number. Our email address is askjill@jillonmoney.com. Don't forget to check out our podcast, Better Off. Get it on Apple Podcasts, Stitcher, Google Play, SoundCloud, anywhere else you find your favorite podcast. We will talk to you next week. Take care.